Right. Welcome, everyone, to this explainer. Today, we're unpacking a really crucial piece of the new Income Tax Act 2025. Whether you're a chartered accountant, a tax professional, a student grinding through the syllabus, or even a business owner, navigating tax law requires absolute precision. In this session, we're going to look closely at exactly how the new law treats the collision between past business losses and newly discovered undisclosed income.
Let's kick things off with a high-stakes scenario. Picture this. A tax search hits a business, and suddenly, the authorities uncover hidden, undisclosed income. Now, the taxpayer, obviously panicking and hoping to minimize this massive new tax bill, wants to use their existing, totally legitimate brought-forward business losses to offset that newly discovered income. So the big question we're tackling today is, does the law actually allow this? Can a regular business loss act as a shield against undisclosed income found during a search?
Here is our quick roadmap for today. 1. Introduction to Section 120. 2. Breaking down the law. 3. A practical taxation example. 4. Compliance and common issues. And 5. A key takeaways summary. Let's jump right in.
Section 1. Introduction to Section 120.
Okay, if you're a veteran of the old Income Tax Act of 1961, Section 120 is kinda gonna feel like déjà vu. As the official guidance, specifically FAQ question 8.9, clarifies, the restriction on setting off losses against undisclosed income remains identical in its core principle. Basically, Section 120 of the new 2025 Act directly mirrors the strict boundaries we already knew from Section 79A of the 1961 Act. The government's objective here is crystal clear: no tax evasion shields. They absolutely do not want taxpayers using legitimate business struggles to wipe out the tax impact of money they actively tried to hide.
Now, before we get into the real nuts and bolts of the law, we absolutely have to talk about a major terminology shift. Under the old 1961 Act, we constantly juggled the terms previous year for when the income was earned and assessment year for when it was taxed, right? It was a bit of a headache. Well, under the 2025 Act, that whole system has been simplified into one single concept: the tax year. The tax year literally just aligns perfectly with the financial year. So income earned in financial year 2026-27 is just assessed in tax year 2026-27. No missing years, no overlap. Whenever we talk about carrying forward losses from here on out, we're using this new tax year terminology. Section 2. Breaking down the law. So what does the law actually say? Well, it establishes an absolute non-negotiable rule. Section 120 explicitly states that any loss, whether it's brought forward from previous years or incurred during the current year, cannot be set off against undisclosed income. And here's the kicker. This isn't just limited to standard business losses. The law explicitly bars the set-off of unabsorbed depreciation, too. The whole point here is highly punitive. If you hide income, you completely forfeit the privilege of using your past financial losses to soften the blow. But hold on, what exactly does the taxman consider undisclosed income? Well, Section 120 points us straight to Section 301 of the 2025 Act for the precise legal definition. It's a pretty wide net. It includes any money, bullion, jewelry, valuable articles, and yes, even virtual digital assets that haven't been disclosed. It also explicitly covers any income based on false entries in your books, or even fake expenses that the authorities realize were totally fabricated during an investigation. Basically, if it represents wealth or income hidden from the tax department, it's caught in this restricted category. Now, it's important to note that Section 120 doesn't just randomly trigger during a normal everyday assessment. The law requires a specific triggering event. The undisclosed income has to be found because of very specific actions: a search conducted under Section 247, a requisition of books or assets under Section 248, or a survey conducted under Section 253. There is one highly specific exception you should memorize, though. A survey conducted purely under subsection 4 of Section 253 does not trigger this harsh restriction. But for the vast majority of search and seizure operations, Section 120 is absolutely in play.
Section 3. A practical taxation example.
All right, let's see how this actually plays out with some real numbers to see exactly how an assessing officer would treat this. Let's walk through it. Step 1. Our assessee has a totally legitimate, properly filed, brought forward business loss of 10 lakh rupees from a previous tax year. Step 2. A survey under Section 253 hits their premises during the current tax year, and bam, authorities uncover 15 lakh rupees of undisclosed income. Step 3. The taxpayer tries to be clever and offset their 10 lakh loss against that 15 lakh discovery, but Under Section 120, this setoff is strictly denied. Absolutely no way.
So what's the damage? The taxpayer has to pay tax on the full 15 lakh rupees of undisclosed income for that tax year. Period. That 15 lakhs is put in its own little box, completely separate from their normal business computations. Now, their 10 lakh loss isn't destroyed. It remains untouched and can still be carried forward to offset normal declared business profits down the line. But it offers exactly zero protection against the 15 lakhs uncovered during the survey.
Section 4. Compliance and common issues.
Understanding the math is great, but as professionals, compliance is where the rubber meets the road. First off, whenever you're dealing with brought forward losses, having strict documentation and audit-based verification is an absolute must. But here is the really critical filing reality. Taxpayers cannot use procedural loopholes to get around this. If a search uncovers hidden income, you cannot just sneakily file a revised return, suddenly declare that income, and then claim your old losses against it to neutralize the tax. The entire framework of Section 120 is designed to block exactly that. The undisclosed income is permanently tainted.
Now here is a massive misconception we need to bust right now. Sometimes taxpayers, or even junior practitioners, assume that because unabsorbed depreciation has slightly different carry-forward rules than normal business losses, like being allowed to carry forward indefinitely, that maybe it can bypass this restriction. Nope. The reality is Section 120 explicitly names both. Unabsorbed depreciation is treated with the exact same severity as a business loss. Neither one can touch undisclosed income.
Oh, and please pay attention to this massive red flag tucked away in FAQ question 8.8 regarding the transition to the new act. Yes, the new act preserves your old valid losses, but it absolutely does not cure your old mistakes. If a taxpayer filed a loss return belatedly under the old 1961 Act, meaning they missed that strict deadline under Section 139.3, well, that loss was invalid for carry forward back then, and it stays invalid now. You cannot revive a dead, belated loss from the old regime and magically bring it to life in the 2025 Act. Only validly determined losses make the jump.
Section 5. Key takeaways summary.
So let's wrap this all up. Here are your main takeaways. Number 1, Section 120 of the 2025 Act is essentially the direct successor to Section 79A of the 1961 Act. Number 2, the absolute golden rule is zero set-off allowed against undisclosed income. Number 3, this is triggered specifically by searches, requisitions, and most surveys. Number 4, do not forget, this restriction strictly includes unabsorbed depreciation alongside standard losses. And finally, number 5, as you update your practice, remember the terminology has shifted to the much simpler tax year. So, as we fully transition into this new era of tax law, you have to ask yourself, are your past filings bulletproof enough to survive a survey under these strict new rules?
Thank you for watching. Please like, subscribe, and share.
This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.